Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Chicago wheat and corn. I'll start with Chicago wheat. So, let's do a quick recap from my previous commentaries. The first pattern to look at is the well-telegraphed early March to early June sideways triangle. It's not a good example, but it has merit. Primary target in the 953 area was achieved in June. Target X1, the harder to reach secondary target, is still live and in the 700 area. The second pattern is to regard the February 2022 to date action as a big M pattern. By using the more conservative high from May, this gave an already achieved primary target in the 866 area and a secondary harder to achieve target X4 in the 715 area. Thus, we've had two potential, if harder to achieve, targets still operational below the market. So what is the most recent activity about? Well, the leg down, which originally started in May and eased off in early July, is still heading lower, though at a reduced speed. What we have seen in the development of the July to date bear channel is a development of a July to date bear channel, currently 736 even to 821 even, which has calmed down the market quite well, yet still given it a bearish tinge and incentive. Prices are now moving down to test some support in the 739 to 743 area and the 721 to 725 area, as the market was working their way through some early 2022 congestion around the lesser Fibonacci lines at 774 and 779. This is not that far from targets X and X1 that were previously mentioned. So it'll be interesting to see if in the immediate future, if the market takes advantage of yesterday's combined key reversal down and bearish engulfing pattern to push lower. It did open lower today, but it's moved back up a little bit. One thing I should point out, that if the market maintains its current shallow trajectory, may well cause some interesting times. You see, the short medium moving average, currently 858, is descending down at a relatively steep angle. This moving average may well impinge upon the market area as soon as the second full week in September, and it may thereby precipitate some activity. Hence, just be aware of it and keep an eye on it. Chicago corn. The decline in this market first started showing some signs of ending in late July, around the 50% Fibonacci line of the September 21 to April 2022 move at 661 even. It was no more than a hesitation, notably because the long moving average was rising to meet the market. Well, the market met the long moving average, shook hands, and then promptly punched it down all the way till it started to approach the July 2013 high of 564. It was here that prices stalled, as below from 564 down to 528, with actually some fingers extending even lower. We have congestion, recent congestion, significant congestion, dating from May until October 2021. The main core of this congestion was between July to October 2021. Now, the question I left last time in my commentary was whether the overhang of the market from November 2021 to June 2022 would be strong enough to take on the congestion. I said at the time that, and I quote, "It will be a supreme battle," end of quote, and, another quote, "This could get ugly," end of quote. However, it seems not to have turned out that way, as after a single test lower in mid-July, the market turned higher. Now, there are four factors you should now consider about this reactionary move higher. Firstly, and I suspect the least of these four, is and I say this carefully, the possible reverse head and shoulders pattern over July and early August. I am not happy about it, but I should note it, especially the neckline currently at 652. Secondly, and this is something that has already impacted the market, is the declining short medium moving average, currently 635 even. On a cursory examination, it looks like this past Tuesday the market punched through it easily. However, if you look 2 weeks ago, you will see the market stalled at testing it and pull back to take a run at it late last week and this week, crashing through it much as if you would took a full supermarket trolley and rammed the doors. The third factor is twofold. Part one is the same old 50% Fibonacci line at 661 that I've already mentioned, along with the slowly rising long moving average, which I've also mentioned, which is currently 669. Both these combined have so far capped the market and require close attention, as they will be losing their joint power as the long moving average moves higher. Finally, there is the possibility that July to date ascending wedge pattern, currently at 617 to 675 even. Personally, I find this the most elegant of all the four I've spoken about. That being said, we only have 2 touches per side right now, and there is the possibility of this pattern being part of a larger bearish halfway hesitation pattern dating from late June and possibly as early as late April. Now, it's too early to say any targets as yet, or if this is a true pattern, or if the bearish halfway hesitation is a real possibility even. But it could be. So just watch out. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright ZD Tofpik and ADM Investor Services International Limited. Here comes the final bit.